Here we go. Go.
Hey, welcome back to Things They Never Taught Us. I'm glad you stuck around. And I know all those car buyers out there, you were anxiously waiting to hear what we were getting to get ready into next. So I'm gonna just go ahead. Craig, there's a list of things that I think every person should know in purchasing a car. I love the fact that you said, hey, you don't have to take that new car hit. You're right. You can purchase something within 1 to 3 years of the current year that you're in. So if you're looking at if you're in the year 2026, which we are now, you can look for a 25, 24, 23.
23.
Banks will finance within 5 years, but let's stay within the 3 year because you got that idea of the warranty. I love that. Here's the things that I think about and what I like to explain, especially to young folks. Um, One, the cost of the car. And what I mean by the cost of the car is the cost of the car versus your salary. So you're that new college kid that just coming out and they hit you with 120 off the bat because you just that person. Okay, great. You think you rolling in it. You thinking you're gonna go out and go buy the brand new 7 Series, which you can afford, sure, but I don't know where you're gonna be living after that. You're gonna be living at your mama's house, that kind of thing.
Right.
But the cost of the car versus what your salary says that you need to commit to that. Um, the upkeep of the vehicle and the maintenance of the vehicle are two different things. The upkeep essentially is, and you guys have got to understand this, what is it going to take for me to keep this car on the road? Not maintenance, keep it on the road. What's my fuel price? Is this premium and lead? Is it, what kind of is this an electric vehicle? What is it? What are all these going to cost? What are the tires running on this vehicle? That's not your regular maintenance. That's just upkeep. Um, Although routine maintenance should include oil changes, well, this is one you got to deal with yourself, right?
And
You may get free oil change,
your warranty doesn't cover brakes either.
right?
Let's see.
So there are a laundry list of things that you need to look at in that vehicle to find out what the upkeep is going to be. If the transmission goes out for some crazy reason, what is it going to cost for me to do a transmission repair? What is it
Which is
going to cost me to do the timing belt, any of the belts?
which is why you want to be under that manufacturer's warranty, and which is why you want to also purchase that extended uh, service agreement, a service and warranty for your vehicle to protect yourself for those major things like that if that were to happen. The other part is you also want to figure out what your insurance is going to be before you buy the car, because the dealership is not going to let you take that car off the lot unless you have insurance on it. Because once it goes across that curb, they don't want to have nothing else to do with it. That is your car. So
Right.
if you get into an accident, as soon as you drive it off the lot, that's on you.
Who? Because what is it? They give you, I think, is it a week? I used to work for
They
State
won't
Farm.
tell you
Horrible
that.
claims.
I
It's
mean,
it's a it's a week of coverage on your insurance, and if you have already have a car, even your insurance that's on the car that you may already own, it's only going to cover you for a week to 10 days. And I may be wrong on that, but I know it's a very, very short period of time for you to get the car, the new
yep,
car, call your agent and let them know that you got a brand new car
right.
that's due to the policy and they got to make their adjustments. So there's a
Yeah.
gap period
Yes. If you
for that.
are, and you just mentioned something, I'm gonna circle back to that. Yes, they have to. That process is called perfecting the lien. If you're financing a car, that's
Mm-hmm.
called perfecting the lien. That means the insurance company needs to know in the event that you have an accident or total that car, they need to know who they need to cut a check to pay
Mm.
off that car.
Is it going to the bank or is it going to you?
Right. Well, if you're financing, it's going to the bank because they got to get
Mm-hmm.
paid off first. And you mentioned something else that I just thought about, gap insurance.
Bingo.
Got to have gap insurance. What is gap insurance? Gap insurance is in the event you have an accident and you total your vehicle, but the vehicle is worth less than the value. No, if the vehicle is less than what you owe on your loan, your
Mm-hmm.
gap insurance pays that difference.
Mm-hmm.
That's what
So
gap
so
insurance.
so if I total my $25,000 car, my car is only valued at 18,000 now.
Right.
You're saying that in order for me to for the bank to get paid, this gap insurance is going to cover between the 18,000 and what it should be according to what the
The
bank
gap
is.
between the two amounts.
So that I'm not paying that out of
Right.
pocket.
Because if you don't have gap insurance and you're in that situation where you still have money that you owe on that loan, you're
Hmm.
responsible for it.
Ooh.
So you're paying for a car that you no longer drive and is no longer available, but you
And
still got to pay off that loan.
it could be anywhere, whatever that gap is between 18 and let's just say it was the 25, you got to pay
Yes, sir.
that 7 grand out or whatever the
That is
case may be.
absolutely correct.
Wow, gap insurance. And
That's
that's
why,
and is that something that comes from like your major automotive insurance companies like State Farm and Geico or something like that, or is that something that's purchased through the dealership?
you're more than, I think some of the insurance companies still do it, but mainly it is done through the dealership. And I'll tell you why. That money that they sell the gap insurance under, all that falls under the owner's 401k. That's like his 401k money.
Oh, wait a minute. Game.
If you get a service contract, he'll probably offer his own service contract by the dealership and on his own gap insurance. That is his retirement money. That's where it goes.
Things they never taught us. Stop playing with me, Craig.
Hey, I told you, I was in that game. I know how it works, man. That is the game. That is their
Wow.
retirement money. That service contract that you buy and that gap insurance that you buy goes directly to his retirement fund.
So let me ask you this, Doc. So when we talk about financing a vehicle, I got a question. Should I go out and get my own financing and then come to the dealership with that, saying that I went to my bank, Bank of America, I've been banking with them X amount of years, and I simply say, hey, I want to go purchase, you know, a Porsche 911
Hmm.
GT3 RS,
Hmm. Right.
it's going. I got to looking at it used. This is the year I'm looking at. This all the particulars because they're going to ask all these questions.
Hmm.
And I saying, so what can I finance for? They said,
Hmm.
okay, Mr. Davis, we can finance you for 150,000. Oh, okay, no problem. The vehicle costs 120, but we'll finance you up to 150,000. Now, is that a smart way of going about it, or should I just simply walk into a dealership, the Porsche dealership, and say, hey man, I like that used 911 GT3 RS. Can you go ahead and finance me for it?
Right.
What would you say is my best way of going about that?
I say, I would say tr basically both so you can compare. Okay.
Okay.
And instead of going to a major bank like Bank of America or, Chase or anything like that, go to a credit union.
Okay.
Credit unions' interest rates are lower than traditional banks for auto
Hmm.
finance. So you would want to go to a credit union. They can offer you a lower rate. So if your credit's okay, then you can negotiate with the credit union because whether you go to a dealership or if you go to a credit union, whoever's going to finance you, they're going to run what's called a debt to income ratio on you. In other words, they're going to add up all your bills that you
Mm-hmm.
have in your credit report. That's why they run your credit. All
Mm-hmm.
your bills, and then they ask you for your income, your gross income. Make sure you understand that. When you're filling out that application, they want your gross. That is before taxes are taken out. That's the number they want to see.
So that salary number that I signed a contract for, it's
No,
hundred thousand
what is
dollars.
your gross per month? What is that
Okay.
monthly gross before taxes come out? Okay.
FICA,
So
all that other stuff.
they're
Right.
gonna they're gonna do that and they're gonna compare what you pay out a month to your gross income. Okay. If that number is close to 40% or above, they're going to tell you that you need to get a lower payment. Think about getting another car at a lower payment.
Ah.
40% is the threshold. Now, if your payment to income, there's two things they run, debt to income and they
Mm-hmm.
run payment to income.
So
If
debt to
your
income,
payment,
payment to income. Okay.
yeah, if your payment is more than 20% of your take home or your gross pay, they're going to tell you get a lower payment. That is the max. 20% payment to income, 40% debt to income. Those
Is
are
that the same for like a house?
pretty much.
Okay,
Yeah.
so 20% and 40% are the two numbers that you need to make sure that you walk in the door knowing before they
We'll
start
talk
running your
about
numbers.
mortgages on another segment.
Yeah,
And that's
but just for that auto, just
yeah,
knowing 20% payment,
20% payment to income,
40%
40% debt to
debt.
income.
Bam. Okay, I see you with that. I see
Yeah.
you with that. And honestly, mm, even when I was selling cars, I didn't know that was the percentages. I knew you needed to keep it lower than 50%. You can't walk in and that's the key thing about it. When they run your credit, I think what is it, three companies that run your credit, that's a ding hit every single time they
Yes.
do that.
Yes. That's why you don't want too many people running your credit on the same day because
Okay.
um because it can lower your score. Your folks protect your credit score. I can't emphasize
Hmm.
that enough. You've got to protect your because that is your bargaining power. You know, if you got a high credit score, and you think of it like this, if you got like your credit score is like a 450, okay? Think of it as percentages.
Okay.
450 is like there's a 45% chance that you're going to pay the loan back. That's how it's looked upon,
Ah.
like a percentage.
Because this thing only goes to like, what, 900?
Yeah, it can go to 900 or 860, 850, somewhere around in that area.
So if you're in
But
the sevens,
you're in the sevens, you're good. You're
it's
considered
about
good.
70% chance you're going to pay this loan out.
Right.
That's the first time somebody's ever said it like that. That
Yeah.
makes a lot of sense.
That's how you look at it. So it's if you got an 800 score, there's an 80% chance you're going to pay that loan back. They'll climb all over you to give you what you want.
Interest rates, everything. But
Yeah,
the
you can
sliding more
negotiate.
towards sixes and
They don't have
fives,
a whole lot of 800s walking through the dealership. So
no.
they want to, you can talk a little bit with them. Okay. So that's what you want to take a look at. Also, I know, before we got on, you heard me talking with my son.
Hmm.
I'm tomorrow I'm going to pick up a new vehicle from
Okay.
from his dealership. And there's a thing out there called a lease. You can lease, okay?
Hmm.
And leases, and what you do is the way you figure out a lease is take a look at, if those of you who have had a car already, look and see how many miles do you usually put on your car a year? That's what you pay attention to.
Craig, you talking my corner of the world now, brother. Because let me tell you, um, those of us who have champagne and caviar taste on a burger budget, this is a great way to get the car that you want at a lower payment. But here's the kicker. You have got to adhere to the mileage of the vehicle. And if you're smart about it, you got to understand what this, and I forget what they call it. So when you go to return the vehicle, if they value the vehicle over the period of the lease time. So if you get it, always lease the car for the manufacturer's warranty. Don't do more. So if it's a 3 year, 36,000 miles,
Oh,
that's
yeah.
exactly the lease that
Don't
you
go
got.
past 3 years.
And don't go over 36,000 miles.
Right.
So if they value, let's say that you want to get a Mercedes E-Class,
Hmm.
and they value the car after the 3 years that you got it, because it's going to be brand new, or you can lease a used car, but I'll tell you to go ahead and get it brand new.
I wouldn't lease a used car, but go ahead.
You get it for the manufacturer's warranty, bumper to bumper, 336,000, just as an example. If they said that Mercedes E-Class after the 3 years, when you're getting ready to turn it in, it's going to be valued at $40,000,
Hmm.
and you go back to return it, and it's actually valued at $47,000,
Hmm.
they have to return back to you $7,000.
Hmm.
So I'm not telling you to go out there and lease a Kia. I'm telling you to go out there and lease the model that you want. So go ahead and tag it up.
Yeah.
Get every option that you want on it. But you have to be a person who keeps the car meticulously.
Yeah. You got to keep that car. Pretty much, you want to turn it in the way that you got it. Okay.
It's like an apartment. It's like,
No dings, no scratches, no you was out here now you bought it back looking like a crash dummy. No, sir.
and burning up the miles on it, going over your mileage package. Don't do it.
Yeah,
But
because you will pay per mile that you went over. That's a
so
fee.
so the so the difference between purchasing the vehicle straight out over the 5 to 7 years and leasing it for the 3 years, the purchase model says that after you're done, you own it. It's yours. Okay. And you take all the depreciation hit and everything else with it, but it's yours. Okay.
Mhm.
But if you lease it, the beautiful thing about it is, especially if you have a business, but I'll come back to that. If you are leasing it and you get the model that you really want instead of the one that you're selling for, you always want to look at what they're going to value it at after the lease is over and take that ideal of what this is going to be valued at so that you can get that money coming back to you.
Mhm.
Now, it doesn't work with every model. It doesn't
No.
work with but there are certain ones that tick that box.
Yep.
I just so happened I used to work in a dealership. I used to tick that box all
There
the
you
time.
go.
So it was easy to tell them. And if it was a business, hey man, dude, this is called a write-up. It's not under
Yeah.
your name, it's under the business name.
Right. So if you pay
Craig.
attention to your miles and you know on a consistent basis you don't do more than 12,000 miles. Like for example, me, I live 7 miles away from my office for my
Oh,
job.
dude, you ain't gonna hurt the car.
Yeah. So it doesn't make sense for me to purchase a vehicle if I'm not putting that many miles on. Plus, I have my motorcycle. I can ride that on days that I don't feel like being in the car.
I'm living vicariously through your life, Craig. I want to be like you, man. And with that note, y'all, we got to come right back here on Vibe AZ 24/7 on things they never taught us. I hope that helped you out with thinking about, purchasing a vehicle, and we got more and more to come back. I know Don is gonna be like, "Yo, y'all didn't call me to come on and talk on the show."
It just
Don, we
happened,
got you,
Don. It just happened.
We're gonna get you, Don, and Mike Jackson. I know he's ready to jump all over that too, man. So, hey, we'll be right back here on Vibe AZ 24/7. It's me, your man Dan, and Craig here on Things They Never Taught Us.